All right, folks, welcome to the opening ceremony of UTS. Today is going to be a brief introduction into what we are going to do. So to begin with, the objectives. There's 5 main objectives of UTS. Number 1, understand the charts. When you open TradingView and you see the candlesticks, what does that mean? What are you looking at? The odds are that most of you don't know and don't care, which is incorrect and incomplete. You have to be in the correct frame of mind while trading. You have to know exactly what's happening. What are you trading? What's at least a brief understanding of the history of the charts. You have to understand the markets. What's the purpose of the markets? Were the markets created to flip $100 to $1 million in 2 weeks? Nope. They were created to generate a fixed, semi-predictable annual income or annual return. And they are best used by the biggest institutions and hedge funds in the world and by the wealthiest people the correct way, which is producing a predictable annual income. You can stretch it a bit and predict a monthly return, obviously. The things you can do with the charts, they're quite the achievement. But never stray from the main purpose of the markets, which is generating a monthly income or generating an annual return, right? Sure, you can eventually, if you have the skill, you can easily flip accounts. You can easily achieve an extremely large % gain in a short period of time. Yes, that's also possible. But the main objective is producing a steady monthly or annual income, right? We'll go more into it in the later chapters. Secondly, avoid herd mentality. 95% of traders lose. Therefore, you'd think it's a lot easier. Everyone looks for an edge. Right? Everyone looks for the new holy grail. But if everyone's losing, then you'd think that the simplest answer is to simply fade everyone, which it is. Right? So avoid herd mentality. Third of all, achieve independent thinking in technical analysis. What does this mean? This means you don't care about anyone else's charts, weekly outlooks, threads of trade breakdowns, fucking bullshit. None of that matters. All that matters to you is you and your charts. Everything else is secondary and background noise. Right? So you don't look for signals. You are the signal provider. Right? Number 4, achieve excellence in analysis. Before I became profitable, and I don't like using that term, I'll get into that later, but before I started getting serious results in terms of monetary gains from trading, like serious results, I was losing, obviously. The only thing that kept me going was that I saw that at analysis, I was great. I was one of the best in the world. And that kept me going, right? The ability to analyze. Again, I'll go more in depth into analysis. How do you use analysis to generate an income in in the later chapters. And finally, achieve excellence in execution. As we know, analysis and execution are two, they're worlds apart, right? They're not even the same galaxy. So achieve excellence in both analysis and execution, because the worst thing you can do is be a good analyst and a subpar trader with bad execution. And the secret is easy. If you want to become a good backtester, then backtest more. If you want to become a good analyst, analyze more. If you want to become a good trader, execute more. UTS. UTS is divided into two main parts. Number one is the video library. Number two is the private chat. Your focus should be mainly on this. Right? So your major focus, the vast majority of your attention span should be spent looking at this. Chapter 1, what are the markets? Why turtle soup? Chapter 2, advanced market profiles. Chapter 3, how to pick the best turtle soups. Chapter 4, advanced range theory. Chapter 5, 3 bread and butter turtle soup models. Chapter 6, execution and trade management. And finally, Chapter 7, piecing together the puzzle of trading. How to trade successfully, at least theoretically. The private chat is going to be a live stream of correcting mistakes, potentially more. Application of the concepts, I'll be there to monitor. And correction of beginner mistakes by the senior students, verified by me. And the third section, perhaps I'll add it afterwards, one-on-ones. Before starting, here's the study instructions. First of all, understand the gravity of the journey you're embarking on. You don't go on the first day of medical school and try and do an open heart surgery, right? You don't go on the first day during your engineering university career. You don't go on the first day and demand to construct a building, right? On your first day in law school, you don't go and demand to defend the country's biggest criminal. You just don't. It's a process. Same way, you don't come into trading 2 weeks in and demand the markets to give you $1 million, right? To flip $100 to $1 billion with the Excel spreadsheet. You don't. It's a process. It's a career. And if you're smart, it's going to be the shortest and most successful career you can ever choose. All it needs is 3 to 6 months of intense study and you're free. So 3 to 6 months of intense study and then 3 to 6 months of intense getting used to, and you are set for life. You have a skill which nobody can take from you, which is yours forever. But those are the prerequisites. Secondly, undivided attention is paramount. Go and unfollow everyone except me and ICT before starting. A lot of you follow way too many people, right? And that causes a distraction and scattering of the attention. Do I look at his turtle soup or his thread or his trade breakdown or his video, his YouTube, his Discord? Pick one mentor, 2 at the very max, and stick to them. the only people I learned from, and I hold the world record for the highest accuracy, live verifiable track record in the world. The only person I learned from is ICT and my own charts, which led to my own discoveries, right? Third of all, study with a notepad in hand. I've seen many traders along the years, a lot, with decades and decades of experience, 20, 30, 40, 50 years of experience in markets. They all had one thing in common. Well, they had a bunch of things in common, but one of the main characteristics they had in common was attention to detail. As I speak, you should be writing down the questions that come to your mind and think critically, right? So write down the questions. Why is he saying this? What if he's saying you should sell an old high? What if it keeps going higher, right? Ask yourself logical questions, logical, critical, well thought out questions as you watch, right? Don't binge watch. Don't Netflix watch. Watch like it's a career, because it is, right? So the notepad and the pen is crucial. And that's all I want to tell you today. I'll see you all in chapter 1 on April the 11th. That's in a couple of days. I wish you good luck, good trading, and welcome to UTS. All right, folks, the long anticipated chapter 1. If you're in a hurry to consume information, then sit down, relax, take a breath, take a deep breath in, grab yourself a cup of coffee or tea, and let's get into it, which is what are the markets and why turtle soup. Now, before I start, I want to make something clear. You need to strip yourself of any information you have before this, right? If you want to make the most of this, that's my advice. If you want to half-ass binge watch it, do what you want, right? I can't help you. But if you want to make the most out of this, then before we even start, completely strip your brain of any information you know regarding the markets or trading or whatever, right? And if you are a previous old student of mine, level 1, level 2, SOT, then do the same thing. Watch it with a new leaf in your head, right? Completely with a clean slate. That way I can guarantee you that those who do that will milk more information from this than those who come and try and catch a holy grail or catch a plug-and-play strategy, right? So before starting, completely format your brain from all the garbage and nonsense you've been taught before by others who are not me. And let's start. So, a brief history lesson on the financial markets. The first ever stock exchange was founded in the early 1600s with the Amsterdam Stock Exchange. And the first company to publicly trade its stock was the Dutch East India Company, one of the most dominant forces in the 16 and 1700s. So trading and the stock market goes back almost 4 or 5 centuries back, right? Trading goes back thousands of years, but the stock market goes back 400 or 500 years. The charts go back 300-400 years, right? So it's not something new. There was an influx of liquidity in COVID when people were desperate to find a way to make money online, right? But the history is rich. And the reason I say this to you is to inspire, and this section of the lecture is to inspire you to think. Most of you probably, and your families, probably 9 out of 10, only know how to put food on the table if you work for someone else, right? That's one kind of people. The other kind is people who have businesses handed down to them generation to generation to generation to generation. It's a business family, right? It's a trading family. I know people in the industry. They're a trader. Their father was a trader. Their grandfather, their great-grandfather, all the way back, right? So if you're from the working class, if you're an employee with an employee mindset, then there comes one person who cuts that link off, who breaks the chain, and that could be you. Just some food for thought. Right, so from the 1600s all the way up to today, with the stock exchanges we have now, with of course the NYSE being the largest, and amongst others, that's setting a foundation of how to think of the markets, right? Next, which market should you trade? The safest market, which has been in an uptrend since its birth all the way up to now, is the S&P 500. Right? So if you're an investor, a long-term investor, then the safest bet you can make is buy the S&P. Right? Buy the correction, of course, in the S&P. And over the course of the next 10 years, you'll be in net profit, right? So that's the most secure and safe vehicle of investment there is, especially for those who have large capital, right? But for everyone. And of course, you have the foreign exchange, you have the cryptocurrency markets, and other markets, which need not be mentioned. Right? But these are the 3 main markets you should be focusing on. And they're the ones I focus on. Now, why turtle soup? Why did you come here? Did you come because it was trending? Because everyone on Twitter was talking about it? Because you saw it happen and you didn't know how to get in? Like you can see turtle soup, but you don't know how to trade turtle soup yet. Why? Why not just go and trade an RSI? All right? You wait for a higher high on the price, and a lower high on the RSI divergence indicator, and you sell. It's that easy, right? A harmonic, draw some crabs and bats with fib levels, or even double top, sell the neckline break, EMAs, Wyckoff, Elliott Wave. Why should we ignore all of these and go to turtle soup? The answer is simple. Because for price to move, right, in order for price to even to go up or down, before every price leg, before every expansion, before any significant price move, there is always a turtle soup. And every single concept you see over here works because of a turtle soup. Turtle soup, turtle soup, turtle soup. Usually at the 0.618 level, there is a range in a turtle soup, and that's a model by itself. Failure swing, turtle soup on the other asset, turtle soup, range, turtle soup, decline, right? So all of these work because of turtle soup. Every single thing on the chart you see, and you trade currently or traded before this, it all worked because of turtle soup. So if that's the case, then why waste time learning anything else? Makes no sense. So logically, you are wrong to try and invest your time learning anything other than turtle soup, right? So step one is recognizing that. Step one is recognizing that turtle soup is the only way or the most correct way. You see these people battling in social media, discussing what's the best strategy. And the answer is, all strategies work. You can make money flipping a coin, right? You can literally guess. You can time your trades, buy, sell, buy, sell, buy, sell, and with good risk management, you'll make money, right? So that's the answer. The answer is anything. Do you need to learn turtle soup to make money? Nope. Is it the most efficient, effective, simple at the same time? So it's the most efficient, most effective, and simple of all the strategies you will ever see. And that's why I adopted it as my main model, right? Everything I do is based on turtle soup. Anything new I learn, I try and fit it to turtle soup. Especially ICT, right? Of course, this applies to everything, but especially applies to ICT. For example, turtle soup, of course, is falsely breaking below an old low or breaking above an old high. That's all it is. In simple terms, you're falsely inducing sellers down here and stopping out buyers, or, of course, not you, the market makers, right? So they're pushing price above this high, making everyone buy, and stopping out the sellers in profit, and then tanking, or vice versa. A breaker, right? The down close candle that caused the bullish purge, or the up close candle that caused the bearish turtle soup. That's the definition of the breaker, right? So this this one specific candle, the breaker, that caused the purge, and then it tanks. You look at the opening, the closing price, excuse me. All right, open, high, low, close. And here's something for you to go and dig into. One of the techniques to get almost a zero drawdown entry is going to be using the closing price of breakers. Right, so the breaker is a breaker because of turtle soup. The order block, right, the thick down close candle, model number 1. So they use this thick down close candle to push into the old low, multiple old lows, even better, and then they close above it. That's an order block, and that is only valid because of a turtle soup. Right, so if you trade a breaker, you wait for turtle soup. If you trade order blocks, then you're waiting for turtle soup. If you trade an FVG, right, the FVG, the highest probability FVGs occur after a turtle soup, right? So turtle soup, bearish imbalance, SIBI, or turtle soup, and then you have bullish imbalance, right? So everything works because of turtle soup. And OTE is waiting for the second leg of the turtle soup, right? Turtle soup, expansion leg number 1. OTE. Based on this expansion leg comes the OTE, right? Measured movement. Standard deviations, turtle soup. So add the correct standard deviation, right? if the previous candle is ranging, you look for a turtle soup to happen. Market maker model, which I will speak about in depth in the next chapters, also a turtle soup based concept. By itself, it's garbage. Any of these concepts by themselves are useless garbage. If you pair them with the turtle soup, then that's the highest quality setup you'll ever see. If there's no turtle soup, then there's no trade, right? No raid, no trade. And with that thought, which is everything is based on turtle soup, everything. I hope you found that insightful. Wish you good luck, good trading, and see you in the next one. All right, folks, welcome to Advanced Market Profiles. So to begin with, what's more important, technical edge or risk versus reward and risk management? What's the answer? If your answer was technical edge, you're wrong. If the answer is technical edge and risk to reward, risk management, are equal, you're also wrong. The answer is that risk to reward, sound money management is always going to outweigh the edge. Here's why. If you have a technical edge that produces a win rate of 25%, you only need 1 to 3 risk to reward to make money, right? Which means if you're wrong 8 out of 10 times, almost, you can make money, assuming you risk $1 in return of a $3 gain. If your edge produces for you a 33% win rate, you only need to risk $1 for $2 in return. 40%, 1 to 1.5, 50%, 1 to 1, 60%, 0.7 to 1. And the higher your win rate, obviously, the less you need to risk in terms of risk to reward. Another thing is position sizing, right? Risk management. Let's assume you have a system which gives you a 90% win rate, right? So you win 9 out of 10 trades. And then you have bad risk management. So you bet too much, you risk too large. I don't like to use the word bet. So you risk too large, and then all the 9 trades are wiped out in one. That in itself is enough proof that technical edge is irrelevant. All that matters is risk to reward and risk management, right? 2 different things. This is how much you risk for how much you gain in return. And that is how much percent you risk per trade, right? And that I'll touch on later on. But for now, understand that the technical edge, whatever the turtle soup, ICT, SMC, same thing. Supply and demand, Elliott wave, Wyckoff, harmonic, whatever. Whatever this is, it doesn't matter if you don't have a good risk management protocol, right? So always keep this in mind when you're looking for enigma, when you're looking for the next great thing. There is no next great thing. The best thing there is turtle soup. The way I teach it and the compilation I've made of it, which you're watching right now, right? From chapter 1 through 7. Everything else is inferior. Everything. And I don't care who tells you what. I don't care whose mentor agrees or disagrees with me. I couldn't care less. Because once you have a conviction of what the truth actually is, then you don't need anyone else's opinion, right? When it's a fact you can demonstrate, which I have demonstrated to you just now, is that edge is irrelevant, then that gives you two things. It gives you a sense of peace, and it halts the wild goose chase of looking for the Holy Grail, obviously. And it allows you more focus on perfecting one system, right? Because it's not that important. As long as I can manage my risk, I'll make money. Now we have that out of the way. Now, obviously, I know some of you skipped the first two, trying to find some important stuff. Every single word is important, right? There's nothing I say with no purpose. It's all built to design you into being the trader you want to be, right? How do I know? Is because I am that. Right? So nothing I say is out of place or extra. Just a side note, I've designed every single piece of information I put out on the internet to be digestible and consumable and effective enough to carve my family members into successful traders, right? So I don't do this for random internet strangers. I do it for my family, right? So as I'm producing this, I have my family in mind, right? What would make it easy for them to find success in trading? And that is probably partially why I have a higher rate of success when it comes to number of students and the level they reach when compared to any other of these goofball mentors on social media. So bear that in mind and appreciate that, right? Because most people you follow online, they use this as their main source of income. I don't need this. I have a job. I make a lot more trading than I do with these mentorships. Right? It's pocket change, contrary to popular belief. So appreciate the fact that I don't need to do this, and I'm doing this. I can be I can be in private. I could never have joined social media. You would never have known I exist. And I guarantee you, the ICT and trading community would be in a worse place, in a much worse place. Right? But of course, I could never sleep with the guilt of knowing what I know and watching everyone literally burn to the ground, shooting themselves in the foot, which is why I'm here. Right? Appreciate that, understand that, and I hope that helps you look at my content through a different lens. And now we have that little mini rant aside. Market profiles. Traditionally, market structure has a very basic, unimpressive definition, which is higher highs and higher lows. High, low, higher high, higher low, higher high, higher low, higher high, higher low. You can trade this because as we've established, you can trade anything and make money. But this is not an accurate depiction of what happens. This is false. What really happens is this. The correct way of looking at market structure is, in a bearish market, price will reject highs and break through lows. and then range. Anyone who's trying to catch this, catch continuation gets chopped up, gets suckered in at the high, and then crashes again, right? Rejecting highs, breaking lows. SMT on one pair is a turtle soup on the other pair, on number 3, right? So rejecting highs, breaking lows, rejecting highs, breaking lows, and so on. It's a bearish market. Turtle soup, turtle soup, turtle soup. Rejecting lows and breaking highs, breaking the highs that broke the lows, right? So range, trend, rejecting the lows, breaking the highs. If you break the high, you're going to reject the low. Write these down, right? If we break the high, then expect a range and then rejecting a low and the continuation. Right? It's very simple. I can't make it, I've thought of many ways to make it simpler than this, but I can't, right? This is as simple as it gets. So if you don't get this, then that's not a good sign, right? So watch it again. If we reject the lows and break the highs in one range, then the next range that we break is going to reject the low and break the high, and so on. Market profiles. Everyone says structure, but I like profile better. So when you open any chart, right? Any chart, when you're done watching, to probe the chart you're looking at, ask yourself, are we trending? Are we ranging? Because the market is always in 2 states. The market makers have to keep the model, have to keep the market flowing in 2 states at all time. In a range, and then a trend, and then a range, and then a trend, and then a range, and then a trend, SMT, and then a trend. Everything lies in this. This right here is a power 3, battle of the open, for example. Same over here. Right? That's a continuation. This is chop, generation of interest in this range to trip their positions and then rally. Right? So trend, range. A range is when the market is visibly consolidating. So it's going up and down between 2 price levels. Right? So it's stuck between 2 price levels. That's a range. If it's breaking out of price levels and retesting them to rally again, then it's trending. It's that simple. Now we move on to advanced market profiles, right? As back as the 1800s, you have Dow theory, right? A lot of these mentors teach you, or they try and teach, because they frankly suck at it, but they try and teach market structure. If you ask them where did it start, they have no idea. Right? It all started with Charles Dow. High, low, higher high, higher low, higher high, lower low. This marks the end of the uptrend and the start of the downtrend. However, this is a perfect picture, but this is the common mistake that most educators make, right? You don't see the importance, and they never put the importance on specific highs and lows. This high is irrelevant. This low is irrelevant, right? The only highs and lows I care about is not this. So this Dow theory. So the founder of this theory of market structure has missing information, and what we've done is we've improved, by we I mean me of course, is we've improved upon their shortcomings, right? So you focus on specific highs and lows, and that's it. Important highs and lows are the high that broke the low in a bullish market. So when bullish, we wait for the high that broke a low to be broken through, and that unlocks the bullishness. The confirmation, of course, is one close above. Preferably displacement above the high with multiple candles, with a rush, with a shower, with a fountain of green candles, followed by a period of consolidation, and then a smack back into this high, which produces a second impulse leg. That's the OTE, right? This is the breaker, of course, but don't look at the pattern. Look at the logic. The logic is that highs and lows are used by smart money to move the market. So when you see smart money, and this is how they signal to each other through turtle soup and SMT, they use these two things to tell each other what they're going to do next, right? So you can either go on the ride with them, right? So take the signal, which they use for each other, which I'm giving to you. Use that and ride with them. Or wait for the SMT, right? Either turtle soup or the SMT, because the SMT is the turtle soup. When you see a market rejecting a low, that means the low is sponsored by smart money, and it rallies. When you see price breaking through a high, now we know that turtle soup is trying to sucker people in above highs to smack it back down. So when you see it not being used for that, then you know that they don't have an interest in selling above this high, and they have an interest in selling higher somewhere, right? So from high to high on the left side of this chart, another high, and so on, right? So what we're doing is we're probing the highs and lows to get a sense of the signals of where smart money, the market makers, the market owners want to move the market. When bearish, we wait for the low that broke a high to be broken through. So they show us intention of bearishness by rejecting the high, and they show us an intent of continued bearishness by smacking through the low. So they show no intention of defending this low. When you enter a trade, ask yourself, am I sponsored by the market owners, by smart money? Is my low being rejected, or is this being disrespected? And if the low you're trying to buy is being disrespected, why are you buying? You don't have enough capital to move the market, right? So you need to wait for their confirmation. You have to watch out and keep an eye out for their sponsorship. The confirmation is on close below the low, preferably displacement, which means a strong wave closing below the low that broke the high, low that took us to the high, and then it's broken through, right? Followed by period of consolidation. So we smack through it, we consolidate a bit, and then we retrace back into the low for a second leg, so OTE. And more on that in the next chapter. Here's a depiction of how the markets move. So you have this here, rejecting the low, breaking the high. Therefore, if we break the high, we will reject the low, and so on. The specific high that broke the low was never displaced, and I know this is a depiction, this is an illustration, but if you go into your charts, which you should when you're finished watching, then you'll see this exact same thing happening again and again and again, right? The lows that broke the highs, unless they are displaced through, the market is bullish. So all along this way, nothing happened. We've never broken through an important low. As soon as we break through the important low, From that moment in time onwards, the market is bearish, and we can expect a continued dump lower, and vice versa. Bearish market, turtle soup, smack back down. We never flip bullish unless we displace and close above the high that broke a low. Right? Sometimes they're used for turtle soup, by the way. That's a discussion for later. But the point here is that important highs and lows. Always pay attention when probing the market. What are they doing? Here's some Maya training. What do you see? Look at the highs and lows, right? So the high, you could argue they've been broken, obviously. That's a random high. Pick the highs that broke the lows, or the lows that broke the highs. In this instance, excuse me, you have this high over here. Have we closed above it? Yes. Have we rejected the low? Turtle soup? Yes. If we're rejecting the low and we're breaking through the high and disrespecting bearish PD arrays, it's a breaker, right? The down close candle that caused a bullish purge, breaker. Disrespecting the breaker, right? So we're breaking highs and we're rejecting lows. What does that mean? That means you're bullish, and we're waiting for a smackdown below low to rally higher. So we're respecting the lows. They're breaking through the highs, break the high, disrespect the rejection block, close above the high that broke the low. Right? From this moment onwards, we're bullish. Right? And you pair that, of course, with this range, chop, 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 sell side, buy side, we smack into it. Everyone's bearish, buy here and rally. And I bought this, by the way. It's not some hindsight trade. This is a trade I actually took by myself. You can look in my the Telegram media. You'll see it. All right. Eventually, you'll have the ability to buy at the low itself. That's simple. With time. But for now, just get used to marking the highs and lows. Which one is being rejected? Which one is being broken? And of course, a nugget is that the false market structure shift usually gives the strongest and most impulsive price legs. One-sided movements. That's one way to catch them. Another one. Market structure shift. Yes or no? Anyone who is credible in the school of market structure in the world will tell you that this is a bullish shift. And they would all be wrong. Right? The market structure pattern traders are wrong. If they're objective, they'll admit to it and come and learn. Turtle soup, as they should. But they won't. The human being is an arrogant creature. So I don't expect much from them. However, you guys who joined me on this endeavor, I expect you to at least have traces of critical thinking left in you. Ask yourself, forget everything. What is this? This is a low. This is a high. This is the high that broke the low, or this one too. Right? Swing high, broke the low. We closed above it. We displaced above them both. Why did this fail? Market structure doesn't always work. It's the harsh reality that you have to come to terms with. And from then onwards, you may progress. Market structure it's a good method. It's a good technique. We've established that a goddamn coin works, right? So it's a decent method, especially when paired with the important highs and lows. But why did this not work? The answer is in the upcoming episode. I hope you found this insightful. I wish you good luck, good trading, and see you in the next one. All right, folks, welcome to how to pick the best turtle soups. The short answer is time, and that's discussed in SOT. However, you can also determine the best turtle soups by the if-then principle. Which follows higher time frame order flow. This is a picture which I've posted before. If you've seen it, then observe the finer details. If you haven't, then there you go. Close above equals higher prices. Close below equals lower prices. Wick above equals lower prices. And wick below equals higher prices. This is on determining the higher time frame order flow. Right, so which means the next candle on the higher time frame, the daily, for example. If today's daily candle closes above yesterday's daily candle, what's going to happen? What's likely going to happen is you're going to have a chance to buy below the open of tomorrow. Right? Close above, higher prices. Close below, lower prices. Wick above, lower prices. Wick below, higher prices. Some intricacies. When the higher time frame is bullish, the lower time frame will explode through the highs. And of course, it'll get an electric shock as soon as it touches the lows and rally. Right? So you'll see it have a touch of a low on the lower time frame and then explode above the highs. And I'll illustrate this in a moment. When the higher time frame is bearish, the lower time frame will sink like a rock in the sea. Right? It'll just fall down and down, and you'll buy the low and get wrecked, and you'll buy the other low and get wrecked, and you'll keep buying turtle soups, fake turtle soups, and get wrecked, and blame me for it. No, you're wrong because you didn't know the higher time frame order flow, and you didn't keep it in mind. You were blindly pattern trading turtle soup like an idiot, right? Which is wrong. You should be always monitoring the higher time frame order flow at all times. That's the wise, complete thing to do, right? Because when the higher time frame is bearish, either by closing below or wicking above, right? Then the lower time frame will sink like a rock in the sea. Highs will electrocute price. We'll just have to touch them and sink below the lows. And the lows, of course, will crumble, right? If-then principle, which means if the higher time frame is bearish, then no matter how many bullish PDRAs you draw on the lower time frame, they will get traded through. Here's an example. This is a weekly chart, and your homework is to know which one it is. Excuse me. We close above, right? This means there's a high chance that the next two candles will give a chance to buy below the open. Right, so close above, wick below, and a massive green candle, an up close candle, right? This means the higher time frame is bullish, right? Let's see what happens in the lower time frame. If the higher time frame is bullish, the lower time frame lows will be used as a launch pad to launch price above the highs on the lower time frame. And if the higher time frame is bullish, then if the higher time frame is bullish, then the lower time frame bullish PD rays will be disrespected and violated, absolutely ignored, and flipped into support, right? Inverted. So again, this is a key principle. It's crucial. If you're binge watching, then stop and focus, right? If the higher time frame is bullish, then price will fly. No matter what Reaper IFVG you draw, it's not going to work, right? It's going to break through the highs. If you try and sell a bearish turtle soup on the lower time frame and the higher time frame is bullish, you are going to get wrecked, right? Now, and vice versa, of course. Right. This also answers a crucial question, which is, I sold an old high and it kept going higher. Of course, because you were selling the lower time frame during a bullish higher time frame. But how do we determine if it's bullish? Close above, higher prices. Wick below, higher prices. Range taken one side, higher prices. If it's the low taken first, right? It's as simple as that. Key level dynamics. A key level can only be reacted from in three ways: a V shape, an M or W shape, which is the most common and which is the one you look for. This is turtle soup. And of course, multiple touches, which is unfavorable, right? So let's say you draw out the key level. You're really excited, you want to try the concepts. You then draw out the key level, and then it works. It's a V shape, right? This is the higher time frame key level, and this is the lower time frame. It's going to smack into it and abuse the highs. Same here. You were happy, of course. You drew this key level. You bought, it went up. Fantastic. But then, the next day, you marked the key level, and then you sold over here. Great, nice reaction. Let me move myself to break even. And then it stopped you out, and then it dumped. And you go and punch your screen, right? Because you're pissed. Over here, let's say this was the key level. You bought this turtle soup. Fantastic. Stop break even, and then it smacks back into your stop. And then you buy again, and then it stops you out twice, and then it rallies. Sounds familiar? Probably. Because that's a common mistake of you not focusing on the different types of reactions from a key level. One thing is identifying the key level correctly. Another thing is knowing what it looks like from the key level to your target. Here's a deeper look into turtle soup on the lower time frame. You're gonna have the higher time frame key level, and then you're gonna have a short-term liquidity pool or pools. The more the better on the lower time frame. It's gonna smack into the previous liquidity pool. Of course, there's gonna be a time line over here, vertical line. Smack into it. Get everyone bearish. Market structure traders selling down here, and it rallies. Now, where can you find the high probability turtle soups? A high probability turtle soup will always be in alignment with the higher time frame candle order flow. Oh, but how do we determine that? Close above, higher prices. Close below, lower prices. Wick above, lower prices. Wick below, higher prices. Take one part of the range, and then take it to the opposing end of the range, and more on that in the next chapter, right? Will always be fast to accelerate from current price levels at the time will always occur at the opening of new candles, not the end of old candles. And this troubleshoots a common mistake and focus over here, which is I bought the turtle soup, but then my turtle soup got turtle souped. Try buying at the opening of new candles, not the end of old candles. It'll always occur at specific times, always, and it will always be a false breakout of a range. Every single time. Next up, ICT, turtle soup, all these fancy terms. What's the summary? There is no summary. If you look for a plug and play model, you are a lazy person, and you need to change that because lazy people don't make it. Right? The only way to get an easy plug and play model is to first put in a lot of work getting wrecked and paying attention to the details. That's the only way. So the only way to easy is hard. Right? Reminds me of the saying. It's an old Chinese saying. It says, bitter now, sweet later. Sweet now, bitter later. But you can kind of summarize ICT in the power of three. Everything you're looking for lies in the open, high, low, and close, or open, low, high, and close. Right? The open on the left side, high, low, and close, open, low, high, close. If you want a summary of ICT, it's buy below the opening price. This is the foundation. Buy below the opening price when bullish, sell above the opening price when bearish. All concepts are subservient to the open, high, low, and close. You look for the breakers above the opening price. You look for the bullish order box below the opening price, etc. Every bullish turtle soup, and this one is food for thought, every bullish turtle soup that has ever happened below the opening price of the candle. Every bearish turtle soup that ever happened above the opening price of the candle. A deeper dissection of the open, high, low, and close. There are 3 trades per candle, right? And this is a fixed, repeatable phenomenon. If I show this to a 5-year-old, he'll get it, right? Every candle has an open, a high, a low, and a close, or low, high, low, open, low, high, and close. Excuse me. Right? That's a fact, and you can see it every single day, every single candle. And I mentioned on Twitter that the moment it clicked for me was when I discovered and when it came to light that every single candle has its own PO3. The 1-minute candle has PO3, the 5-minute candle, 15, 30, 1 hour, 2 hour, 3 hour, 4 hour, 1 day, weekly, monthly. They all have their own PO3 and you can play with them however you like. And me mentioning that should make it click for you. Because that's all there is to it. Open, high, low, and close. Power of 3. Buy below the open when bullish. Buy below the open bullish. And sell above the open when bearish. How do you determine? By the closes. Close above higher prices. Close below lower prices. Wick below higher prices. Wick above lower prices. Of course, every candle you get the open. You get the open, the low. OTE, high, close. London, New York, whatever. All those names are a depiction of this open, high, low, close, OTE. New York, quote unquote. So what ICT did was he branded this, which this concept is old as hell. It's not something new. It was first introduced by Larry Williams. Right? I suspect he took it from someone else. But the concept is new. It's not new, excuse me. Right? open, low, high, close. And a book I recommend is Long-Term Secrets to Short-Term Trading by Larry Williams. It's a good book. But that's it. Asian session, quote unquote. The names are a good way to get people together, because signs and symbols and names of brands rule the world. So if you tell the people it's New York, right, it makes more sense than telling them that it's the second trade of every candle. I bet that's what it is. This is another concept which I made public, which I never intended to. The elements of a high probability trade setup. A higher time frame key level, manipulation time, and pre-manipulation liquidity pool. And it's the smallest for a reason, right? It's the least important. Here's a picture I repeat, and I try to repeat this as many times as possible without causing it to be annoying. But this is crucial, right? Plan the higher time frame key level. Mark the manipulation time. What is this manipulation time? It's London. It's midnight New York. It's the 9 a.m. candle. It's the opening price of whatever candle you're trying to turtle soup to the opposing end of the range. It's that simple. Lose sleep over this picture. Think about it. All right, truly delve deep into it. Again, in summary, you buy below the opening price when bullish. You look for your pattern here, OBF, VG breaker, SMT, whatever, right, over here. And vice versa. This is a bullish candle. So if you're expecting price to go higher because we closed above a candle, then you look for this. Buy below the open. Look for whatever entry pattern above or below the opening price. Derive the bias from the higher time frame, either the closes or the range. So if the higher time frame closes above, then you look for price to dump below the open and rally, and vice versa. Open, key level, rally. Open, key level, rally. Backtest this. Because the way to learn is to backtest, confirm the theory, and then forward test. Right, those 3 steps, write that down. Backtest, confirm theory, forward test. Backtest this on every single time frame, all candles, and thank me later. All the focus on the daily and weekly range to keep your sanity. How do you apply all that into trading? Well, that's a discussion of the next episode. I hope you found this insightful. I wish you good luck, good trading, and see you in the next one. All right, folks, we have reached one of my favorite topics, range theory. So if you're bored of the previous lesson, which you shouldn't, then you'll enjoy this one. What's a range? A range is one of the 2 ways the market moves. Trend, range, trend, range. It is how the market makers generate liquidity through interest by accumulation of buy-side and sell-side liquidity. Above old highs, you have buy-side liquidity. Below all lows, you have sell-side liquidity. What this does is the following. You'll see the market chopping between 2 points, range high and range low. What this does is create the interest of selling a breakdown and buying a breakout. It's the way that most schools, even ICT traders, the dumb money pattern trading ICT traders who don't understand power of 3, that's how they trade, right? Breakout traders. What usually happens is it'll smack into one side of the range, and usually the first breakout of the range is a fake move. Write that down. What this does is three things. It invites the short sellers. It plants doubt in the breakout buyers. Some of them even flip to short selling. And it stops out whoever bought the rally before the dump in the range low. Right? So it's three parties getting robbed of their money. How? That's how they do it. Range, consolidation, accumulation of buy side and sell side, smack into one end of the range, and then rally to the opposing end of the range. Right. Usually, oftentimes, giving no chance for entries. Right. A range is also the market taking a breath before the next move. So it's a trend, a massive trend, and then it has to chop around, because if the market moved up and down in lines like this, then everyone would make money and no one would lose. Right? So they have to get a sharp move, and after the sharp move, those who want to follow the trend, they get chopped up and they continue with the sharp move. Right? It's the market mechanics. Also, for the curious eye and the astute pupil, this is a market structure shift, a fake one. Range trading rules, because trading without a system is gambling, right? I don't want to know when to enter. You can find 1,000 ways and methods telling you when to enter. What you should look for is systems that tell you when to not enter, right? When to preserve capital. Because if you have no capital, you can't trade. So rule number one, preserve capital. In this case, rule number one of range trading is buy low and sell high. Buy the range low rejections, sell the range high rejections. Don't buy the range low, don't buy the range high, and don't sell the range low. Right? So when you see a range, you never buy the low. You never sell the low, and you never buy the high. Right? And you try and buy the low or near the low, and you try and sell at the high or a rejection of the high, especially if it's the first move. The target is going to be two. Number one is the 50% of the range, and the target two is the opposing end of the range. Always take a partial at the 50% of the range. Always, every single time. And if you focused more on taking trades which went from the opposing end of the range, or one side of the range, to the 50%, then you'll find a lot more trades and you'll have a much higher win rate. Alright, so in summary, buy low, sell high, buy range low, sell range high. Don't buy range high, don't sell range low. Target is 50% and then the opposing end. Right? Because the liquidity they got here, they have to distribute it above the high and the old high. They must. Now, here's some eye training. Range high, range low. Never participate in the middle of the range. Do nothing. Right? So, what does the rule say? It says buy the range low and sell the range high, or sell the range high and buy the range low. Never sell the range low, never buy the range high. Let's see what happened. It'll reject the range low, produce an order block, right? This one specific thick down close candle, which went into the low. As soon as they close above it, right? That's the candle. You want to buy inside of this range of this candle. And target one is the 50%. Usually, when range trading, then at target one, you'll find some sort of rejection before flipping it, and then using the 50% as a level to jump and break out of the range. Right? As a sequence that happens. And that's also can be used as a way to validate your range, because in order to avoid ambiguity of the range, see, is the 50% being respected or not? Because that's usually an indicator. Again, you have this, a range high, range low. The market is clearly chopping, right? Between point A and point B. The rules say buy low, sell high, buy the range low, sell the range high. Don't sell the range low, don't buy the range high. Target 1 is 50% of the range, and target 2 is the opposing end. And of course, validation off of the 50% by rejections, smacking into it. This one specific thick down close candle is the candle you're using to buy into to target the 50% and then the opposing end of the range. More on Model 1 in the next chapter. Right? The extremities, if you're a range trader, and range trading is an extremely profitable route to go. I personally know many 6, 7, 8-figure traders who do nothing but range trading. Nothing too advanced. It's price ranges, right? So visibly look for a range low or range high to buy or sell. Right? Look for a range, wait for it to get souped at one end, turtle soup, and buy here, sell here. It's that simple. With, of course, if you want to confirm, with model number 1 being the confirmation. Right? Thick down close candle, let's stab into the low, close above, buy into it. As a range trader, the extremities are your playground. You don't touch price except if it reaches here or here. Everything else is a no trade zone. Next up, we have the types of ranges. We have price ranges and we have time ranges. And this is where the 3-candle model comes in. What do you see? What's happening here is, and this is something I was very reluctant to share to the public, so use it wisely and appreciate it. What happened is this one specific candle is being turtle souped, and according to range trading rules, we target the 50% of the candle and then the 100%. Candles are ranges. Every single candle is a range on every single time frame. Ranges can either be turtle souped or broken out of and retested. Some candles are, by nature, more high probability than others. The market is made through ranges, as I've said, to determine the higher time frame bias, which is a big issue in the IST community. Just look if a higher time frame candle has been turtle souped or not, and that will give you the key to the bias. Don't force it. When it's happening, it'll make itself very apparent to you. Range trading rules apply to the candles. So buy low, sell high. Don't buy high, don't sell low, and target 50%. Always take partials. In this case, this one specific candle, if we didn't close below it, then it's a turtle soup. Target the 50% and the rest of it. Within this candle, you have this candle. This one specific candle, and this is a weekly chart, and you should know exactly which one it is. This one specific candle is being turtle souped, and the third candle is going to the target. That's why I call it the three candle model, and a lot more on it in the next chapter. Right, so the 3-candle model. Candle number 1, candle number 2, turtle soup. Never closed above, therefore target the 50%. of this candle and the opposing end of the range. All right, so candle 1, turtle soup, and then attack the 50% of this one specific candle and the opposing end of the range. What makes ICT the concepts, and what makes the concepts I present special, is dealing with specific candles. Every other system, supply and demand, Wyckoff, market structure, all that nonsense, all that garbage, is trading zones. You can do that, but it's more accurate and more consistent even to look at specific candles and what's happening. Same over here, by the way. This candle, turtle souped, and then you target the high of the candle. This candle over here, turtle souped, and then you target the 50% first. Range trading rules say take off a partial at the 50% at all times. Now, we didn't close above this one, but we closed above this one. Therefore, there's a conflict of interest, and you look for a turtle soup because close above equals higher prices. Now, that was a mouthful and a mindful, so watch it once, twice, 3 times, because this right here, what you see, is the key to the markets. One of the most crucial elements that exist. So use it well and study it well in private 1,000 times, see how it works, and then come forward to show it to the world. I hope you found that insightful, and I wish you good luck, good trading, and see you in the next video. All right, folks, welcome to bread and butter turtle soup models. To begin with, let's clear some misconceptions about trading models. A trading model, it must repeat every day. That is correct. Why? Because whatever happens on the higher time frame happens the same exact way on the lower time frame. Because price is fractal. So is time. A trading model must be easy to understand. A trading model must be interpreted by 2 parties in the same terms. So it must be concrete and transferable. Finally, there is no holy grail. There are only probabilities. Some are simply higher than others. Some models are simply higher probability than the other ones. A trade model guide. Every trade model boils down to these 3 things. Number 1, an entry. Number 2, an exit. And number 3, a stop loss level. Entry, of course, can be both price and time. I'll go briefly over 3 specific models. First of all, the 3 candle model. Second of all, model number 1, plus. And third of all, a quick buck model. Before delving into the models, here's the base of every single high probability model. It's a consolidation, turtle soup, expansion, market structure shift, a true market structure shift, which happens in the form of a consolidation, expansion, retracement, and expansion. All right, so when you mark a key level, this is what you look for. So expansion number 1, then the OTE, expansion number 2, and vice versa, consolidation, expansion, leg number 1, and then you smack back into the consolidation over here, which leads to leg number 2. All right, so this is an opportunity, and this is also an opportunity, and the OT is the turtle soup every single time. All right, so the psychology is that the people waiting to buy the key level, they get chopped up, they FOMO, they buy early. It then stops them out, induces short sellers, shift, wrecks everyone, goes through the high, they buy up here, they get wrecked again, the OTE wrecks them one last time, they sell down here, it's breaking down, but no, the structure has shifted, the market is now bullish, and once you break a high, then you dump below a low only as a turtle soup to rally again. All right, here's a depiction on the chart. Key level, you're going to have a low, a high, a lower low, a higher high, so you close above the high that broke the low. Remember, chapter 2, market profiles. And then you get an OTE, turtle soup, and then you rally. Leg number 1, and there's an extremely high chance when you have this formation of leg number 2, and it's going to be the same size as leg number 1. That's your target, right? That's price-wise. How about time? Time. The high of the daily candle forms at London, right, which is 1 to 5, with an OTE at New York around 8 to 10 a.m. And this OTE will continue the direction of London or reverse in the direction of the weekly candle. This is the daily candle, right? Next up, you have the weekly candle. The high or low of the weekly candle forms from Sunday, Tuesday, Wednesday. Sunday to Tuesday during the London session of Tuesday, right? So that's the time zone you're looking for the high or low of the week to form. And the opposing end of the range, with a double P of course, is capped on Thursday and Friday. The high and the low, the high or the low of the monthly candle will form in week 2 and 3 of the month. These are also the 2 highest probability weeks of the month. SMT is crucial. SMT is available at all the important highs and lows. Next up, we have the 3 candle model. So we're going to go straight into the models. All I ever need to trade is 3 candles, and you'll see. And if you study this the way you're supposed to, then all you'll ever need is going to be 3 candles, right? The most common and obvious 3 candle model trades or models are the Monday range and the Asian range model, right? All right, folks. First of all, we have the Monday range model. Now, some people on the internet claim to teach it, but every single teaching about this model is incomplete. All of them. The reason being is that they don't understand that candles are ranges. All right, so Monday's a range, Tuesday is a range, and Wednesday's a range. Each range has its function, right? When trading the Monday range model, apply range trading rules on the Monday candle. So Monday, accumulation. Tuesday, turtle soup. Wednesday, continuation. The Monday range is either going to be turtle souped, falsely broken out of, or it will be broken through and used as a key level. So break and retest, basically, right? There is no other state or condition that can happen, right? It's either going to be turtle souped or it's going to be broken out of and reused as a support or resistance level, right? The true support and resistance level is ranges. Target 1 is always going to be 50% of the Monday range. Target 2 is the opposing end of the range, right? So in this instance, you have this candle, you mark it out. Okay, turtle soup. As soon as you see this target, this rejection, right? Range, turtle soup, and rejected back into the range, you target 50% and the opposing end of the range, right? Every single time. This allows for reevaluation and potential mistakes in your analysis, either by reversing higher or dumping much lower than you thought. Right? And that's where runners come in the next lesson. Here's a visual representation. So you have Monday, one specific candle, turtle soup off Monday on Tuesday, and then you hit the opposing end of the range on Wednesday, right? So you got Monday, range, turtle soup, target 150%, and you'll usually see this consolidation, right? The infamous consolidation in the equilibrium. Now, here's a side quest. What does that mean? What does a consolidation mean? It means that an expansion is coming. So when you say that price consolidates in or at the 50% of any range, that means price is going to expand from the 50% of the range. All right, some food for thought for the astute pupil. And by the way, market structure traders, right? You got this beautiful breaker, got completely wrecked because they don't know the candles or ranges, right? Monday, range high, target 1, range low. If you only focused your entire trading career from now on, from this video onwards, if you focused on only taking trades from the end of the range to the 50%, then you'll have a much higher win rate. Another example, one specific candle is Monday, right? So range, chop. When you see a large wick on either end of the candle, that means there was a lot of chop, right? So this one candle, turtle soup, on Tuesday. So open here, massive rally, everyone gets suckered in. And as I'm saying this, visualize the lower time frame, right? Monday, turtle soup on Tuesday, and then within this specific range, Wednesday gets the low, right? They have an inside candle, which means probably an expansion happened afterwards. Another example, you got Monday range, Tuesday turtle soup, target 1 and target 2. It's the same candle, by the way. All right, so Monday chop, Tuesday this gray area gets turtle souped, and then on Wednesday you get a classic sell, an easy day to trade. Now, market structure works within this framework. Breaker, false, model number 1. Market structure shift, wrong, Monday range. The market structure shift that is in the direction See, market structure works, right? In fact, I use it, and you should use it too. But market structure that is in the direction of the higher time frame only, right? So Monday range, turtle soup, breaker right here, right? High, low, higher high, break through this breaker, right? The closing price. And this one specific down close candle before the purge is the key level. In the light of the Monday range, right? So you're using structure within the higher time frame order flow. That's the most accurate, and that is the flawless way of trading market structure instead of randomly trying to catch every single shift you see. Of course, beautifully, the closing price of the breaker gives you an almost zero drawdown entry every single time. Beautiful. And a breaker is one that takes out a previous candle's high and probably takes out 1 and 2 highs. That's better than the one that takes out 1 high. Next up, you have the Monday range, broken through and used. All right, so Monday, broke through it, and turtle soup. If you notice, there was not a single bullish market structure shift, right? So we're breaking through lows. Because remember, you have to blend market profiles. It's the first chapter for a reason, the first technical chapter, right? You have to blend market profile with this. And if you do that, then you will have a flawless system. Right here. Did we ever break through a high that broke a low? Right? Nope. We wicked above it. That's bearish continuation. Lows broken, highs rejected. This was the chance they had to break above the high. If they break above this high, right? Low, high, lower, low. If they closed above this high, we're bullish. Right? That's market structure. Otherwise, we're bearish. Rejecting highs, breaking lows. So let's assume you don't see this part of the screen, right? Would you buy this blindly? Yeah. You can buy this as this one specific candle, turtle soup, 3 candle model, to the 50%. That's where the magic happens. Right? And watch this more than once. The astute pupil, the smart student, the diligent disciple will lose sleep over this, right? Because what I said just now in the past 5 minutes is literally all you need to know to be smart and take this into your own charts, verify, and enjoy. Next up, you have the Asian range model, right? Asian range model. So you have a consolidation from 8 p.m. to midnight, New York time, right? That's the Asian range time. So you take that specific time because here's a little side piece on the 3 candle model. If you pattern trade it, you'll get wrecked, right? Because not every single candle is going to be turtle souped, obviously, right? So price ranges, you got price ranges, you got time ranges. This is a timed range, right? So from 8 p.m. to midnight, New York time, that's the range I'll use to measure what happens. Do we break out? Do we turtle soup one side? What happens, right? Now, some market structure study for you here. High, low, high, low. Notice the highs, the lows, excuse me, so we're bullish, right? First of all, lows rejected, highs broken, right? And more specifically, the lows that took the highs rejected, super important. High, low, low. Breaking the high, close above, bullish, right? We're breaking above the high that broke the low and then digging back into it and then rallying, right? That structure. Here's another chance. High, low, higher high. We never broke below this low. The high that broke the low is key, and take this into your charts, right? The high that broke the low is key. This is classic Dow theory, right? But when you look at it and blend it with market profiles, then what you have is a deadly weapon in your hands. Low, high that stabbed into the low, broken through, bullish, right? So dumps are for buying. Within this, you have another one. Low, high, low, break above it, dump below, buy. Model number 1, by the way. Now, this one specific candle, down close candle, is a range, right? This one too. And in a bullish market, the highs, the lows that broke the highs are turtle soup, and vice versa. All right, listen to that again. And we kept going up until we got a high, a low, a higher high. We broke through the low that broke the high. That's when the downfall started. At this point in time, right, that's what happened. Obviously, a better entry is this, right? You see this? It's a more advanced entry. This is the 3-candle model up here, right? Candle, range, order block, CSD. Close below, lower prices, right? So these two things I'm giving you are the most mechanical ways of determining bias. The highs that broke the lows, and the lows that broke the highs, and the closing of the candles above and below the previous candles. That's all you need to know for bias, right? That's the fundamental basis of bias. So your homework is go into your charts and look at the relevance of the highs that broke the lows and the lows that broke the highs in determining bullish or bearish bias. Some more thoughts. Traditionally, these highs that broke the lows and the lows that broke the highs, they're used to determine bias, right? What does that mean? That means from the moment you close below this low, right, you displace below it the low that took the high, or vice versa. If you break below it, then from this moment in time onwards, you're going to target the previous lows, expecting a retracement, targeting the previous lows, right? You can also use them for turtle soup. Low, high, lower, low. Never closed twice above. Never. That's turtle soup. So you can use these highs for turtle soup, or you can use them for determining the trend, quote unquote. Determining, are we more likely to go higher? That's what you're determining, by the way. You're determining the answer to this question. Are we more likely to go higher or lower? That's all. You probe the highs and lows. The highs and lows in general, these specific highs and lows in specific. And of course, a beautiful, never close the body above this candle, just gorgeous wick, non-existent, right? The wicks do the damage and bodies tell the story. Just beautiful. Never ceases to astound me the accuracy of these algorithms. And yes, it's not one algorithm. There's many. Next up, Asian range, right? Timed range from 8 p.m. to 00:00 a.m., right, midnight, New York time. You wait for one side to be taken, right? And then you determine a continuation or targeting the low of this session as soon as you get a shift in direction, right? High, low, smash above it, and displace below. You got this one too. High, low, higher, high, smash below. This is objective, right? Smash below it, then use the FVG to target this low. A timed low. Everything is timed. Another note is that I'll leave that in the chat. All right. So remind me in the chat. Talk about the IRL versus ERL and which one to use, basically, because it's being thrown around on Twitter nowadays and being used incorrectly. So I'll touch on that in the chat. All right, so that's it. Now, a pattern trader who didn't have the Asian range in mind is going to buy above this high. And that is exactly the previous highs turtle soup. Right? Range high over here. Turtle soup and range low. All right, so that's the basic summary, and that was a mouthful. That was a dense, super important, very crucial past 10, 15 minutes. Not sure. But watch them properly and apply them in your charts. Go to your charts. Don't just watch this and expect it to magically work. Watch this. And I'm advising you, the viewers, the same way I'd advise my brother or sister, right? Or any family member who wants to learn how to trade. Whatever I'm saying, take it with a critical mind. Go to your charts and verify. That's how you gain confidence. That's how you know. You know what? I've seen it myself. I've seen it happen once, twice, 3 times. And backtest. The history of the charts is gold mine, right? Because history does repeat itself. When you buy an order block, right, you're expecting history to repeat itself, the pattern to repeat itself. Why? Because smart money dumped price below this low because they control the markets, obviously, right? And they used this one specific candle to scare everyone away, and they're going to buy back into it and rally. Right, so it's a repeating logic, and it will never stop working. As long as you have the right to trade, these concepts will work. So if that's your concern, then rest assured that they will work as long as, at least till 2030, that's for sure. But the takeaway is this. Take all of this, right, apply it in your charts, get used to it, and that's when the money making happens. Candle, this one specific candle is a range, right? Gray area. It's going to be a timed range, obviously. This range is getting turtle souped. This is a lower time frame look into the higher time frame candle. Right, so the candle in the higher time frame looks like this. And on the lower time frame, you'll see this. So you're going to target these highs as soon as you determine a change in the trend or direction. Obviously, you're going to take the trade from down here to up here. And excuse my voice, I'm unwell today. Range low, range high, within a range high and range low, right? So there's tons and tons, and there's 10s, 20s, there's hundreds of opportunities per day, right? Range low, range high, turtle soup. You take it to the range high and then you wait. Did we close above the high that broke the low? Nope, right? Okay. Yes, we closed and we created a bullish PD array above the high. Right, this order block right here. Bearish order block, fake, devoured, and these are the best order blocks. The best order blocks are the ones that have a failed order block before them, right? So let's assume everything after this candle is invisible, right? This bullish engulfing candle. Turtle soup. If you're a pattern trader, you are a bearish turtle soup, but you didn't look at the high that broke the low. We closed above it. We're bullish, right? Low, high, lower, low. Breaking above the high that broke the low, and I want to drill this in your head, right? From then onwards, we rallied. Rejecting lows, breaking highs. Simple and advanced market profiles. Candle range, turtle soup, and you sell the next candle above the open. It's that simple. Right? One more thing. Before a true breakout of a range, you will normally have a fake turtle soup like this. You know, some of you tell me that it's usually the off-the-cuff remarks that hold the most value, and that's true. Next up, you have model number 1 plus. So in simple terms, you got a high, you stab into the old high with an up-close candle, and that is your entry level. No, it's not supply and demand. Supply and demand doesn't require you to stab into an old high, right? Nowhere in the book of supply and demand does it say you have to stab into an old high. It does say that you have to have a rally, right? And a rally does come from a key level, but it's not as precise. Nothing is as precise as this. And vice versa. You got an old low, you stab into the old low with a thick down close candle, explode above, and use that thick down close candle to rally again. This is also a range, by the way, right? Range low, range high. You wait for this to form, add the range low, range high. Everything's connected. Everything you learn and everything I teach you is connected, and there is not one single contradiction. And this is a challenge for the skeptics as well. In the concepts, everything is complementary, right? Nothing is contradictory. That's a bold claim, but it's true, right? And if you don't believe that, then verify. Again, over here, you have a higher time frame key level. This is the full picture, by the way. So a simplistic view is this. High, in the most basic terms, if I was to trade one model as a pattern, it would be this. All right, so for the simple minds, those of you who don't want to complicate their lives too much, right? This one is for you. High, stab into the high with an up close candle, close below it. As soon as you close below this candle, you got to sell. Right, is that simple? And vice versa. You got an old low, you stab into it with a down close candle. As soon as you close above the candle, you got to buy. If out of all these videos you take this away, then you've done a good job, right? For the most lazy of the lazy. And now for the rest of you who want to go and look deeper, it's always going to stab into the old high after the opening price of the new candle. There's always going to be a higher time frame key level that leads to the expansion, right? And multiple highs are better than one high, and the highs from the previous candle are better than the current highs, and vice versa, right? key level, stab into the key level, and before you hit the key level, there's always a range, and there's usually a market structure shift. Don't always bet on this, but there's always a range, right? A higher time frame key level, lower time frame range, stab into it, order block, rally. Order block, the thick down close candle that stabbed into the old low. Here's a chart example. Thick up close candle that liquidated an old high. High, low, old high, thick, heavy, high volume, up close candle. As soon as you close below this, right, you can look here as a point of interest to sell. And then, of course, you can sell a continuation over here. And vice versa. You have a low. You stab into the old low with a thick down close candle, a red candle, right? This one specific candle is the candle that causes the rally. This one specific candle is the candle that causes the dump, right? This one specific candle is the one that causes the rally. Close above, confirmed. Stop loss below the candle, or the candle, and target the old highs. Yes, that's a wide stop loss, and yes, there are ways to refine it, obviously. Such as the high that formed, the swing high that formed into this key level is a stop loss, and vice versa. Moving on, how to trade model number one. Mark the opening price, wait for price to print a thick up close candle into an old high, or a thick down close candle into an old low. Wait for them to close above the down close candle or below the up close candle. Enter at the specific candle's high or low in the direction of the higher time frame order flow, as everything. All right. So here, for example, down close candle that goes into an old low, close above higher prices. Down close candle over here, this one specific candle. It's always one specific, it's not a zone, it's not an estimated area, it's not a guesstimation, it's one specific concrete candle. Over here, use this one candle to rally, and vice versa, right? This thick up close candle is stabbing into these old highs. When you close below it, it's the key level that causes the rally. This one candle is causing the rally. This one candle is causing the rally. This one candle is causing the rally. And here's a note on how to backtest. First of all, you check where it works, right? Because you might say that, for an example, you can't. Down close candle. Let's look at an example that failed. I'm trying to. Old high, up close candle, dump. Right. Let's just say that it fails sometimes, right? That doesn't matter. The point is that you first have to accommodate yourself to seeing what it looks like when it succeeds in backtesting. That's step one, right? And then you try it out live, right? The specific times that it worked correctly, you mark that out. And you try it in real time. It'll work most of the time, and sometimes it'll fail. That's when you study the failures, right? But when you backtest, then you have to have some sort of bias to the idea, because you're trying to accommodate yourself to what it looks like first, right? Of course, you will fail sometimes. That's inevitable. Yes, even I get it wrong. Sometimes that's quite rare, but it happens, right? But first, get used to the right thing. If you don't know what the right thing is, then how can you determine what the wrong thing is? Right? So in summary, all that rant, backtest when it works 1,000 times. And then try it live. If it works, great. Mark everything. More on journaling in the next chapter. If it doesn't work, then mark why it didn't work. It's that simple. Right, again, high, low, higher, high, lower, low, turtle soup. Remember? And this one specific candle is the one used to rally. The pattern, model number 1, will occur with the order block being created, stabbing into a previous candle's high, or a range being created with the order block stabbing into the current candle's range, high or low. First case, the order block being created, stabbing into a previous candle's high, such as here, or low, right? You have the previous candle's low being stabbed into and closed above. Previous candle low, stab. One specific candle causes the rally. Previous candle's high, stab into it, close below, confirm. One specific candle causes the dump. Or it can be within the same candle, right? Like you got it, you have an example over here. High, up close candle stabbing into the high, close below, and you can see that they used it to dump, right? So it's either going to be an old low of a previous candle, right? Open, power of 3. Everything feeds back in the power of 3. Open, dump, old low, when the higher timer is bullish, then you get a rally, right? And this is model 1, below the open. You're bullish, wait for the open, you wait for a range to form, and then model 1 to form within that range, and rally, right? Below the open again. When you're bullish, you buy below the open. You look for the pattern below the open, and vice versa. Entry trigger. Close below the candle that liquidated the higher low. No trigger, no entry, right? You have strict rules to your model. It tells you when to stay out, and it tells you when to participate, right? If there is no close, you have no trade. High probability times for intraday, because a lot of you are a fan of scalping and short-term daily range trading, are 3 to 5 a.m. and 9 to 11 a.m. on the 15 and 5-minute time frame. Finally, and this has been a long, interesting lesson, a quick buck model. In the most simple terms, trade the candle after the candle that hits the key level. Because the candle, and focus with me here, right? Hopefully you've been focused during the entire thing, because not a single word was out of place. Everything is deliberate, nothing is random, right? So focus. And if you weren't focusing, watch it again, and again, and again, with a notepad and pen in hand. You need to be writing down everything. Your thoughts, what I'm saying, the summary of what I'm saying, what your questions are, what's your doubts, everything written down in paper, right? There's a saying which is, knowledge is a prey and writing is the net. Secure and catch your prey with thick nets, thick ropes. It's an Arabic saying. العلم صيد والكتابة قيده قيد صيودك بالحبال الواثقة. Right? So write down the important stuff. Trade the candle after the candle that hits the key level. If bullish key level, buy below the open of the next candle, right? If bearish key level, then sell above the open of the next candle. This model is basically trying to catch the ICT classic buy or sell template, right? And I didn't call it the classic candle on purpose because there's many ways to catch the ICT buy and sell template, right? One of them is this. What the essence of the ICT buy or sell template is that when bullish, in an ideal scenario, you buy below the open, they open, you get one trade here, trade number 2, trade number 3, a classic buy candle. Or you get a classic sell candle, right? Open, rally, sell, decline. How do you catch this? Because if you can catch 4 of these a month only with high accuracy, then that's all you need. That's 4 days of work, the entire month. Right, but how do you catch them? By trading the candle, and this is one of the ways, by trading the candle that, not the one that hits the key level, because that one's usually a choppy candle, right? The one after the one that hits the key level. So it's a chop, chop, chop. Everyone's complaining about the markets being volatile and choppy, right? Everyone's losing. And then you get one smooth candle, right? And this is what everyone's trying to find out. This model is a basic method of how to find it. There are more advanced techniques on how to identify this to the pip, right? And know exactly when, where, and how they're going to happen. What does that mean? That means I'm telling you that there's methods out there which allow you to know exactly when this happens. Open, rally, dump. Or open, dump, rally. That's a more advanced topic for later, but the most basic way to achieve this is through what I'm showing right now. A visual representation. You got candle 1, candle 2. Key level is hidden in this one, right? And the most volatile and easy to trade candle out of all of these, I'm sure you can agree, is this one. Right? Also has a model number 1, by the way. Right? Old high, thick candle, close below, dump. This one specific candle is responsible for this entire dump because it happened at a key level. Right? Important high, a quick revision. Right? High, lower, low, higher high, break, bullish. Right? Bullish. First sign of bearishness. Second sign, and dump. OTE buyers all wrecked. Right. Again, you mark the FVG, right? This candle touches the FVG, your key level, and the next candle is a classic sell. Close below, right? Key level. Assuming there's an old high, and there is, and this is a chart you should be familiar with. It's a higher time frame, important asset chart, excuse me. Candle number 1, chop, and the candle after the one that touched the key level is a smooth sailing. Right, so in summary, trade the candle after the candle that hits the key level. This allows you also to confirm the key level because the structure on the lower time frame that you see on the candle hitting the key level will reveal the intention of the candle after that one. Right? As always, if it's a bullish key level, buy below the open of the next candle. If it's a bearish key level, then you simply open, sell, dump. Open, rally, sell, dump. Right? And remember, everything feeds into the power of three. Everything you ever study, ICT, Turtle Soup, SMC, it must feed back, even the details, right? When I give you details, like for example, by looking at this chart, you already know the candles are ranges, and this one range has been turtle souped into a key level, and is the second candle after touching the key level. So you expect smooth sailing, right? Now, I'm aware that some of this may be too advanced for some of you. And if that's the case, then go back to the old stuff. Go back to the previous lessons. Look into your charts. If you don't understand something, it's your fault. Because you haven't looked at it deep enough. You haven't seen it enough times. If you're confused about a concept, then you simply haven't experimented enough. Right? It's always your fault. If you lose, it's your fault. If you win, it's your fault. If you understand, it's your fault. If you suck, it's your fault. If you lack mental ability, it's your fault. You can fix that. Whatever state you're in right now is your fault. Right? If all of this is smooth sailing and you really found this eye-opening, well, it's your fault. It wouldn't be a fault in that case because a fault is a negative thing, but it's due to you, right? Thanks to you, it happened. Obviously, I am facilitating this to you, right? I'm making it easier. I'm giving you advanced tools to go and potentially extract money from the markets, but the application is on you. Right, so just a side note, addressing those who might find this complicated. It's supposed to be complicated, and you're supposed to go and experiment and try once, twice, 10 times, 100 times, 1,000 times, and eventually you'll get it, right? So, power of three: open key level rally, open SMT rally, open range rally, right? That's all you'll ever see. This is the lens through which you see the charts. Model 1 here, right? But Model 1 came following power of three, right? Power of three doesn't happen because of model number 1, right? Model number 1 happens because of power of three. And this has been a long lecture. My voice is getting raspy. My throat is hurting. It's been hurting for a while, but I'll keep going. Right? The common denominator in all of the trades you've seen me take, in any successful trade you ever see, right? If you see someone trading Elliott waves successfully, then he's trading the power of three without knowing it, right? Everything boils down to the power of three. If you trade a breaker successfully, then you're trading the power of three. If you trade market structure successfully, and yes, they exist, then you're trading power of three. Whatever you trade, if it works, it worked because of the power of 3. SMT, power of 3. Key level, power of 3. Range, power of 3, right? A range is literally it's the embodiment of the power of 3, right? Accumulation, manipulation, distribution, right? So everything has to feed back into this, whatever you study. And it's the most simplistic summary of the markets. This is ICT in summary. Open, key level, rally. When you're bullish, open, dump, rally. When you're bearish, reverse this. Open, rally, dump. So it's going to keep dumping lower. It's going to stop at the key level and rally. It's going to keep dumping lower. It's going to stop at an SMT and rally. It's going to keep dumping lower. It's going to stop. It's going to range and then rally. Right? And each one has its own entry methods. And more in depth on entry techniques in the next chapter. All right, so everything feeds back into the power of 3, all of it. It's always going to be a candle opening, previous high, declining. Now, you can go crazy chasing and pattern trading power of 3, obviously, right? You'd need to be really stupid to do that, right? But it's possible. So always bear in mind the higher time frame, draw liquidity. That will help you trade the important candles. And that concludes this lesson. It was heavy and dense, and I suspect for some of you, it's going to be the most fun one, right? Because I dropped some things which I hadn't spoken about before, neither in public nor in private. So enjoy. I hope you found it insightful. I wish you good luck, good trading, and see you in the next one. All right, folks, welcome to Chapter 6, Execution and Trade Management. Back to the backbone of trading, and this is the holy grail of trading. Understanding this picture right here. If you understand this picture, then you shall succeed. If you truly understand this picture, then you're going to make it. RR versus technical edge. So risk to reward and risk management, the percentage gain or loss per trade versus technical edge. And technical edge, of course, being turtle soup and CRT, right? This is all you should see. You don't see anything else. Many of you, right, I suspect, are following 10s and 20s and some of you, I don't know how you do it, but you follow 1,000 people, right? That's a distraction. You're distracting yourself. If you have 10 different people telling you 10 different pieces of information, right? You have 10 different sources of information whispering in your ear. Kind of similar, but different things, right? It's impossible that you find 10 educators, right? 10 trainers, 10 in any field of life, especially in trading, right? It's impossible to find 10 sources telling you the exact same thing because they have unique experiences. Some have more, some have less, right? So even if you take the top 10 traders in the world, right, and you use them as your mentors, all 10, you're going to fail. You need to pick one and focus on one. You joined UTS, right? And being part of UTS should be a badge of honor to you, right? Being part of the University of Turtle Soup. And the fruits of your labor, the best students will prevail in a couple of weeks to a couple of months, right? And you will make this name proud. That's your mission. That's your job. right? Live up to the name of UTS. You joined this to learn turtle soup, right? And CRT. They go hand in hand. It's not two separate things. It's not a new shiny object. It's always been there, CRT and turtle soup. There is no reason for you to go on strategy hop. If you do, right, which some of you inevitably will, then you're going to fail. Right? You're a failure. And you need to hear that to wake up to what you're doing. You're damaging your chances at success by focusing on more than one teacher, by listening to more than one source of information, whether passively or actively. Be deliberate in the action of grabbing your attention and controlling your attention, which is difficult in the age of social media, right? But grab your attention, control it, and especially when it comes to receiving knowledge, limit your sources of information. I've trained and mentored many successful students along the past year. And if you measure success by money, then hundreds and hundreds of thousands of dollars. By accuracy, extremely high accuracy, right? By life-changing stories, I can pull up hundreds, if not thousands, of life-changing stories, from rags to riches, right? Not even me, apart from mine, right? My students, my disciples, and I'm proud of you if you're one of them. But upon analyzing them, I realized that the most successful and the most favorable outcome goes to those who focus only on me. Is it because it's me? Perhaps. But the fact that they're focusing on one person only, that eliminates 90% of the distractions that are hindering your progress. Right? And I know some of you are going to skip this part and say, give us the sauce. This is the sauce. This is the important stuff. Right? Stop trying to get information from multiple sources. You chose one credible source, one verified credible source. Now stick to it. Right? The edge is turtle soup. If you try and trade anything else, then you're a fool, because everything else happens because of turtle soup. Right? Excuse my sharp tone, but this is an important topic. Right? This is turtle soup. Whatever you trade is going to happen because of turtle soup anyway. Right? So the edge is turtle soup and CRT. From one source, which is me, the author. Now, which one matters? It's a funny ending to that rant. Which one matters more? Technical edge or RR? The answer is RR. Technical edge is irrelevant. It's important, obviously, but if you have to pick one of these in terms of importance, then this trumps this every single time. The percentage gain versus loss per trade and the risk to reward trumps the technical edge every single time, which is why you find shit analysts who make money and good analysts who don't. How does that happen? Excuse me. Now, technical edge is irrelevant. If you have someone who has a 90% win rate, right? So out of each 10 trades, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And if you zoned out during the rant, then snap back into it, right? Focus. If you have someone with 90% accuracy, so trade number 1, win. 2, 3, 4, 5, 6, 7, 8, 9, 10, all wins up until 9. And then on trade number 10, he over leverages, or they over leverage. You got some ladies in here too. And they blow the account. That indicates to you that the edge is irrelevant, because you have an edge. You have a 90%, and that is arguably the best edge there is in the world, the highest performing edge in the world, and you still blew your account. Why? Because you lack risk management. RR, right? So risk to reward has to be positive, and percentage gain versus loss per trade is all that matters. Risk management will grow your account. Risk management will preserve your profits. Here's a generic risk to reward and win rate cheat sheet. So I lied. The edge is sort of irrelevant, but it's less important to risk to reward, which is paramount. If you have an edge which gives you 1-to-1, so for every dollar you lose, you make $1. Risk to reward, right? Which is terrible, by the way. As turtle soup traders, you at least go for 1-to-3, right? But if you have 1-to-1 and it's quite ugly, go and map out a 1-to-1 right now and see how unattractive it is. Even that, if you have a 1-to-1 and you win only 60% of your trades, right? So out of every 10 trades, you win 6, then you make money. All right, so trade 1, win, 2, 3, 4, 5, 6 wins, and then 4 losses in a row. You're going to make money. If your edge gives you 1-to-2, then if you have a 40% win rate, you make money. What does that mean? That means if you have 10 trades and a 1-to-2, then, excuse me, trade number 1, win. Number 2, win. Trade number 3, win. Trade number 4, win. And then 5, 6, 7, 8, 9, 10 are all losses. You will still make money. If your risk to reward is 1-to-3, so for every dollar you lose, you make $3, then you only need 30% win rate to make money. 30%, which is horrendous, but you'll still make money, right? This table right here, this generic Google Images table, is the secret. It's not in the details and the intricacies. It's cool to have 80% accuracy, right? But this should give you closure. This should give you a sense of relaxation, you know? So trade number 1, win. Trade number 2, win. Trade number 3, win. And then 7 trades all losing, you still make money. If you have a fixed 1-to-3, right? And trade 1-to-4, obviously. 30%, 1-to-5, 20%. Right, so if you look at this, you're going to ask yourself, why then, if it's so easy, then why do most traders lose money? Because they lack the discipline to wait for good setups. Write that down. And it's probably the reason most of you lose. Right? Most of your losses come from the lack of ability to wait for good setups. Your aim is 1-to-3 with a 50% win rate. Right? So win 1, lose 1 to start with. If you have that, then you're going to make more money than 90% of traders alive right now. Right? 1-to-3 and 50%. If I ask you right now, do you know your win rate? You don't know. If I ask you, what's your average risk reward? You don't know. right? You're simply, it's most likely that you're simply, you press buy, you press sell, you see an FVG, you sell, you see a breaker, you buy, right? Sounds familiar? If it does, then I'm not surprised, because that's what most people do, right? Mindlessly press the buttons. No, think, stop, frame out a plan, right? And execute based on that plan. And there's a plan coming at the end of this chapter. But as soon as you enter the markets, all you're looking for is a 1 to 3 and a 50% win rate. Boom. Profitable. I never thought I'd use that word. Boom. There you go. But that's what you look for. All right. 1 to 3, 50%. Yes, mine is higher, obviously. 80% publicly, 90% privately. All right. But aim for this. 1 to 3, 50%. It's super easy. You can do this. You can achieve this with an RSI strategy, right? So focus on the amount of R's you produce. And by the way, next up is the percentage gain versus loss, right? Now, percentage gain and account size. If you have an account, and this is not going to be popular, if you have an account below $10,000, then just don't bother. All right, forget about trading. Yes, you've been fed on social media, especially from the African Twitter, right? $1 to $10,000, right? $100 to $100,000. It's a bunch of crap. And the people who do that, I've spoken to them, right? I know them. Hey, you know what? I grew this account from $1,000 to $25,000 and then blew it up the next day. It's very common, because with high risk comes high reward, but there's still high risk, right? This is not sustainable. The idea of explosive account growth. Yes, you can do that. Yes, I will dedicate a specific chapter to that inside of the group chat, right? Along with 2 special models. But your mindset should be set on this: a small percentage gain per month. Excuse me. Aim for 6% per month, right? If you get 6% per month, and you might laugh at it right now because you've been polluted by social media of the dreams of gaining 100% per day. But if you get 6% per month, that's around 70% per year, then you're outperforming every single hedge fund there is, every single bank, every single institution, every single fund. You're outperforming everyone, right? Because most traders, at the end of the year, they're net negative. Right, 6% per month. Pretty simple, right? Very simple. But the hard thing is stopping yourself. You want more. You want more. You want more. You want more. You keep wanting more until you lose everything you made before, right? And that's the nature of the game. The market gives, and the market takes, and the market always makes sure to give you the taste of profits, the taste of quick money, just to sucker you in a bit more, and then grab it all. It's like a kidnapper, right? That's a strange analogy. It's like a kidnapper luring in a child into a van with a lollipop. Right? So you're the child. The market is a kidnapper. And it's going to take you into the van of loss, luring you in with a couple of wins. Here's 1, here's 2, here's 3, and boom. Account blown. How do you avoid that? By controlling your risk. When you start losing, right, Get rid of losers quick. If you're bleeding from your wrist, do you watch until your entire body is drained of blood and you say, oh, I'm dead now? No, you don't. As soon as you start bleeding, you locate the point where the blood is coming up from, and you apply pressure and stop it, right? So when your account starts bleeding, stop it as soon as you can. Cut losers quickly and let winners run. $10,000. You can go if you have less and you have nothing else to work with, then sure. Then use every 4 hours as a monthly candle, right? And use this as your aim per 4 hour candle. $10,000, 6%, 0.5 to 1% per trade. You never ever, under no circumstance, do you risk more than 0.5% to 1% per trade. Never. Excuse me. And with a 1, 2, 3, right, you're going to make a lot of money very easily. And when you lose, you won't lose that much, right, based on this. Into application. Let's say you have a 1 to 3 risk to reward and a 50% win rate. So trade number 1, you win 3%. Trade number 2, 6%. Trade number 3, 9%. Trade number 4, 12%. Trade number 5, 15%. Right? Because you're winning 3% per trade and risking 1%. 15% for 5 trades. If you lose the next 5 trades, you're down 5%. In total, 10%. Right? It baffles me how most people have no idea about these simple concepts, right? Simple math. Just that formula alone, by the way, is enough to pass all these prop firms, quote unquote. Now, when you tailor this risk management system into CRT and Turtle Soup, that's when the magic happens, as you'll see. Now, decrease risk in half. This is an important point. Most of you, in fact, ignore this, right? All of you just trade 1 to 3s blindly, right? 1% loss, 3% win, and trade like that. If it's stop loss, then keep going. The numbers are on your side. Don't think about the next 10 trades. Don't think about the next 100 trades. Think about the next 1,000 trades. All right? Decrease risk in half with each 3 losing trades. So 1% to 0.5%, and then 0.5% to 0.25%. And then put it back on with having 3 winning trades. Right? With max risk, the roof of risk is 1%. The minimum risk is 0.25%, right? So minimum 0.25, maximum 1%. And this stops the bleeding considerably, right? You can't lose money. What I've said in the past 10, 15, 20 minutes, not sure, with that rant, I have no idea. That was a long rant. But what I've shared so far, if you apply it, then you can't lose. It's impossible to lose money. You can't. And this is why a professional trader is very comfortable in their skin with their strategy, because they know that the numbers are on their side. It's also why the prop firms, by the way, they're also very comfortable selling you demo accounts, because they know that 90% of traders, 95% of traders are going to lose the money. All right, so it's a 95% win rate business. Might open one. Anyway, so focus on the risk per trade. Very important, especially if you're one of these prop firm, quote unquote, traders. And it's a shame to call these prop firms these online casinos, right? Because a real prop firm is something so much more serious, so much more. It's incredible, right? The difference. But you're never allowed to lose more than 1% per trade. Never. You can't. You're forbidden to lose more than 1% per trade. Analysis versus execution. Next section. Analysis is entry, target, exit. Even this basic level, most people get it wrong, right? Because they're following the wrong people. You'll find on Twitter right now, you'll watch this lecture, you'll take your notes, and then you'll go scroll Twitter. You'll see people with charts, with lines covering the entire thing, and you ask yourself, how do they see anything? Right? It's ridiculous. But step one is analysis, obviously. You need to perfect analysis. You need to at least practice a lot of analysis before executing, right? Don't rush. Don't look at the guys I repost, right? They're seasoned students, at least some of them, right? But don't compare yourself with anyone. Compare yourself with yourself, right? So don't be in a rush to make money. Don't be in a rush to analyze. Take your time. The markets aren't going anywhere till 2030, right? Take your time in perfecting your analysis. And if you focus, if you maintain laser focus for the next 3 months, not even 6 months, 3 months, every single day, diligently 6 hours a day, then I guarantee you, right? So if the recipe is focus on whatever I'm saying, right? Devour my content for the next 3 months, 6 hours a day. At the same time, you're focusing on one asset, predicting every daily candle, every weekly candle, right? Noting down your mistakes, trading it live with a small account, not a demo account, right? A small live account, which won't affect you, but will sting you a bit, right? And at the end of 3 months, those of you who follow what I said just now are going to be so many light years ahead of everyone else. All you have to do is listen. Now, analysis versus execution. Analysis is entry, target, stop loss. Entry, invalidation, stop loss. This is step one. Excuse me. I'm sick today. Which one is more important, analysis or execution? Well, they're both important, but an analysis without execution is fruitless. Right? Yeah, you get some views, you get some claps, you get some likes, but if you didn't make money, then what's the point? Right? So execution. Focus on execution. And they're worlds apart. Don't think because someone can analyze that he can trade. Right? It's not true. He can analyze perfectly, but perhaps he gets wrecked. Let's say you predicted this move, right? You might enter an over leverage at the high, get stopped out because of slippage, and it goes your way, right? You might exit out of fear over here at this bounce, and then it dumps, right? These are things you gain with experience, with more time at the charts, right? Nothing replaces chart time. So execution, right? You have to blend the two. Most traders suck at even analysis, right? First, master analysis, then move on to execution and blend them together. Execution. Now, what do you see? Very basic level. You see a 3-candle model, right? Candle 1, candle 2, candle 3 is probably going to trade up here, right? Or the next candles are going to trade up here. That is correct, right? Candle is a range, turtle soup, 1, 2, 3, 4. So you look for buys until the high. Now the thing is, the analyst says, wow, it worked, yay, Romeo the GOAT, mentor, legend. But the trader says, wow, it worked. How could I have taken advantage of that move? All right. You look for buys below the open of the next candles, right? So you go to the lower time frame, you frame a 1 to 3 RR entry, and you look for buys, right? Again, over here, what do you see? All right, range, accumulation, manipulation, distribution, right? Correct. Wow, it worked. Wow, that's incredible. Let me go scroll Twitter now. No. You think, how could I have milked this move? I never analyze without a stop loss. What does that mean? That means I'll say, you know what? Yeah, nice. Range high. It's probably going to go to range low from this FVG, right? So displacement, thick up close candle that liquidated the high. This is model number 1, right? My favorite entry. Entry of the FVG, just in case they do an IO Fed, right? Stop loss at the high of the FVG. An FVG entry has an FVG stop loss, right? Swing high over there. 3 candles. Excuse me. So I'm relying on this swing high to hold. I'm framing a 1 to 4 to the opposing end of the range. Target 1 is here. Monitor price here with an expectation of acceleration down to the range low, right? Now, these 4 charts show the same price picture. The difference is this is analysis, and this is an analyst's mind, and this is a trader's mind. You don't think what happened. You think, how could I have milked what happened? How could I have made money from what happened, right? You're not a chart artist. You're trying to make some money, potentially, off these charts, right? NFA. Now, the way to think about this is as follows. Every key level, now, before you enter a trade, hopefully, at this stage, you at least mark a key level, right? Because key levels are being created every single day. Every trading day, there's key levels being created. Every trading week, there's new key levels, right? The previous day's highs and lows are a forever key level, right? Previous candle high and low, forever a key level. So hopefully at least you depend on key levels, right? So the way to think about it is as follows. Every key level owes you a 1 to 3. Every CRT owes you 1 to 3. Every trade owes you a 1 to 3, right? So when I look here, I say, hey, you know what? Nice range, right? This range is probably going to go down. I'm going to try and get a 1 to 3. And if you don't like 1 to 3s, yes, I'll teach more, like 1 to 5s, perhaps even more. But 1 to 3s are enough to make an incredible trading career, right? They rack up with time. 10 trades, 100 trades, 200 trades, 1,000 trades. They rack up pretty quick. Right? So whatever your trade model is, it owes you at least a 1 to 3. Now, a touch on trade management. Your job, most of you, right? Your job is, and your mission is this, a fixed 1 to 3 RR. If you want to trade a 4-hour order block, 1 to 3. If you want to trade a daily order block, 1 to 3. Right? Keep training yourself on 1 to 3s to begin with, right? Break even is a scam. And a touch for the advanced students over here, before I go here. Pyramiding is one way to accumulate risk and reward, right? For example, turtle soup, first entry, 1 to 3. Model number 1, order block, entry number 2. usually a 1 to 4, 1 to 5. Breaker, until the closed liquidity pool, right? That's also going to be a 1 to 3. So that combined is a 3% risk per move, and at the same time, it's a 11% reward, right? Backtest that. The sequence, remember? Entry 1, turtle soup. From every high time frame key level, there's 3 entries. Entry 1, turtle soup. Entry 2, order block. Entry 3, breaker, OTE, right? Break-even is a scam. I have a saying, which is your stop loss is the turtle soup, and your break-even is the OTE. Right? How many times have you put a break-even stop loss, and it stops you out, then moves your direction, right? That's the psychology of the break-even, right? The break-even is never supposed to be used unless there's a displacement, unless there's a breakout of a range, right? Then you go and break even, because that specific high you entered from, if you have an advanced entry, the specific high you entered from should never be traded to again, right? Excuse me. Never move your stop loss. Let the whole prediction play out. This applies to most of you, right? Fix 1 to 3. Never move the stop loss. The numbers in your favor. The numbers are in your favor, right? Note down what price does from the time you enter till the time you exit every single trade, right? This is Tom Dante's Demon Finder on eliminating mistakes, right? So per week, right? He says throughout the month, but throughout the week, check yourself on this, on these demons. I won't explain this. I'll let you read it. All right, simply the mistakes you can commit, how many times you check, how many times you made them, and if you make one specific mistake more than 8 times, then stop trading, right? Bet too large 8 times, probably a common one, stop trading. Study, right? Study the losses. This is part of journaling, by the way, right? Apart from the basic journaling, which is noting down and documenting every single trade you take, right? Forever, till you die. Because that's how professionals do it. Now, let's go ahead and touch on it, right? Demons will destroy your edge. Learn from your mistakes, and as you know, I'm a very loud advocate of eliminating mistakes, because once you eliminate a specific mistake, right, then you'll never make it again. That's the vow you're making. For example, let's say you're used to selling below lows, right? Once you make a rule for yourself, never sell below a low, then you have freed yourself from that mistake forever. You understand? Do you understand the importance? That means you'll never lose money ever again because of that mistake, right? And this is an important, it seems like a sub-segment because it has no slide, but this is very important, right? Every mistake you make, once you eliminate the mistake, then if you truly identify the mistake correctly and eliminate it properly, then from that moment onwards, you will never make it ever again. Now, how incredible is that? Right? You will never sell below low in your life, in your entire life, in your entire trading career, right? You will never sell below a low because of the rule you made for yourself, because you tried to eliminate mistakes. Now, learning from your mistakes is the only way to achieve success. I can give you turtle soup and CRT, but when you go and apply them in your charts and you make mistakes, right, and then you go and eliminate the mistakes and focus on what worked, then, and only then, will you find success, will you find profitability. Throughout the month, place a check mark in the corresponding box each time you encounter a demon. I say a week, not a month. Determine which trading demon is outpacing the rest. Eliminate that demon as quickly as possible. So I'm suspecting most of you have this one. Betting too large, obviously. Over-leveraging is one of the biggest killer accounts there is in the entire trading industry. And it's why a lot of brokers offer high leverage, right? Because they're playing on that statistic. If you suffer the same demon 8 times in a row, you should seriously consider whether trading is for you. Now, this is semi-satire. All right, everyone makes mistakes. If you make mistakes, it's okay. Right? If you don't trade as you want to trade, if you don't trade as well as you see others trading, and that's fine. We all started somewhere, but you need to be hypercritical of yourself, right? I'm not going to pat on your back and say, you know what, it's okay, keep losing. No, lose only if you can learn. Only if you're going to learn from the loss, right? If you're going to lose and repeat the loss, then that's just foolish, right? Lose, dissect the loss, and never repeat the loss ever again. If you lost money selling below a low, then you should never lose money selling below a low ever again. Fooled me once, shame on you. Fooled me twice, then I'm an idiot, right? And that concludes this chapter, folks. Watch it 1, 2, 3, 4, 5, 10 times if you have to, right? It's very important. It is the key. Along with the next one. I hope you... The most common question typed out. You're saying it's they feel overwhelmed and it's a lot of concepts. Right, okay. So to begin with... Okay, all right. To begin with, I'm giving you a toolbox in UTS, all right? UTS isn't a model. It's a toolbox of many different tools to allow you the ability to be an independent thinker, right? Which means you can use all the tools in different market conditions. You can use some tools in trending markets. You can use some tools in ranging markets, right? Different markets, different market profiles. And market profiling is the first thing you do when you open any chart, right? It's the reason why you can't have one model fits all, right? The same person who looks for one model fits all is the exact same person whose strategy hops, right? So knock it off. Think what I'm saying. What I'm saying is that there's a ranging market and it has a model, and there's a trending market and it has its own model, right? That's what it all boils down to. Trending market, turtle soup. Ranging market, turtle soup. Right? So stop forcing, stop rushing results, right? It comes to understanding, dedication. How about this? If you're new, right? 6 hours a day, every day for the next 3 to 6 months. You sit down and you analyze the charts, analyze every single daily candle. One of the common causes of distraction to traders is multiple markets. If you really want to master a certain market, do you know that you have to predict every single daily candle beforehand, mark your observations before, during, after, every single weekly candle before, during, after, every single monthly candle before, during, after. So if you're doing this with 10 asset classes, of course you're going to be lost, right? You can't focus. You need to have one market, right? Preferably with three correlated assets, right? So EU, DXY, GU, enough for a lifetime, right? ES and Q, and maybe the Dow, right? You don't need it. But find three closely correlated markets and master them, right? Master trading one while using two others as confluences, right? A specialist is always more valuable than a general practitioner in any field of life, right? Even in medicine, right? A neurosurgeon gets paid more than a physician. Why? Because he knows more in one specific field, right? He's an expert. He knows the brain like the back of his hand. Uh, if you're a forex trader, then I should say, you know what? Adam, for example, Adam knows EU like the back of his hand. Edward knows gold like the back of his hand. He knows when the high of the day is going to form. He knows when the low day is going to form. He knows how many points the manipulation is. He notes how many points the average distribution is. Right? He's a master of his market. Now, be honest. Most of you. Can I say that about you? Probably not. Right? You just scan through 10 different charts looking for a trade. Right? Master one market. There's more than enough pips. There's hundreds and hundreds of millions of dollars circulating each currency, and especially the large ones. And there's enough for you, right, to make a living for the rest of your life. So that's the answer. In summary, focus on one market and practice. Specialize. Next question, Adam. No. There's no one time frame. Two time frames. One market, one model. Turtle soup, right? Reversal turtle soup and continuation turtle soups. And you link the turtle soups to model number one, right? That's it. That's your job. All right. Um, push this question to the end. Next question. Mm-hmm. Right. Entry techniques. The entry technique which I will promote to you, to most of you, uh, whether you're advanced, whether you're beginner, is model number one. Right? It's the highest accuracy. It's the simplest, right? And when blended with the correct turtle soups, it has also the highest risk to reward. Right? So CRT blended with model number one. Right? The example is right here in front of you. Right? So you have, for example, you choose any CRT. Which ones? You can use the ones in the mentorship. The Monday Range CRT. Right? It's a very popular one, and it's put there for a reason. Right? Another one is the 5 a.m. candle CRT on the 4-hour time frame. Forex. Right? But the model is going to be mark the candle, right? Daily, 4-hour, weekly. Wait for a turtle soup, right? And then you always find model number one. Don't force it. Just let it come to you. The best trades will come to you, right? I'm sure a lot of you are familiar with this, right? You see some trades, they're so obvious and so quick, and they go so smoothly. You win. You win at once, right? You wish you bet more. Those are the trades you want to take, right? You don't want to force trades. So you have this, right? Old low, stab into old low, right? Okay. There is no entry. You consider an entry, right? Untouched order block under a low, FVG2, right? So you consider entry here, but the actual entry is triggered once you close above this one specific candle. That's model number one, right? This one specific candle is the entry. Target 50% and the opposing end of the range. Normally, it's going to hit the second target. All right, it's that simple. Model number one. If you only focus on this model till you die, then you're doing a great job. Right? I often have a saying, which I don't say that much, which is if you only knew how to trade one thing, right? If there was only one strategy that ever existed, then you'd make money. Like instantly, because it's the only thing you know. Information overload is both a blessing and a curse. Right? So you have all the strategies at hand. You can simply Google them. So that's a blessing. The availability of information is a blessing, but it's also a curse because now you're distracted. You don't know what to focus on. Right? Focus on this. Turtle soup. Yeah, turtle soup. Confirmed by model number one. Your risk is this candle. Right? Risk the candle, stop loss of the candle, reward the range. And if there's a turtle soup that happened to this one specific candle, it's even better. Right? And you'll find another one. You'll find a mini model number one inside here. That is where high risk to reward trades come from. Inside here. Next question, Adam. Yes. My favorite model is model number one. Right? Because sometimes, its mere existence is usually in confluence with the higher time frame anyway, right? Because if the higher time frame was bearish, then they'd never close above this candle, right? You can go back into your charts and check this out, right? So a turtle soup. Now my entry is obviously going to be down here, right, in the mini model one, right? That's me. That's an advanced entry. Forget about that, right? Focus on this model number one. Close above. Then you have this as your entry, the high, stop loss, and target. Right? Suffer some drawdown. Tough number bit. All right, but model number one. Every single candle is going to open, and this model, by the way, happens every single day, right? Every single week, every single 4-hour candle. This model exists. Model number one. Price is always going to open, decline when bullish, stab into an old low, create this model, and rally. Price is always going to rally, right? So open, rally when bearish. Let's get an illustration. Why is it green? It's supposed to be green. All right. All right. So when you're bearish, then you're looking for price to rally using the if then principle. For example, open, rally, old high with a thick up-close candle, right? A lot of momentum. It's exciting everyone. And then they close below it and they dump, right? That's the move you're trying to catch, all right? And back here, you'll have a previous candle, right? Nothing magical about the ranges, just a previous candle, because candles are ranges, right? You'll have a candle with a previous high, which was stabbed into, right? And this one picture is a market maker model, quote unquote, right? Bearish, this is going to happen. This one thick up close candle, turtle soup, and decline. Your entry is going to be here. As soon as they close below this candle, you enter, right? And my favorite entry sequence is the sequence, right? Entry 1, turtle soup, from any higher time from key level. Back to this. Entry 1, turtle soup. Entry 2, order block, right? All number 1. And entry 3 is going to be a breaker or an OTE. Next question, Adam. Right, so they're losing money. Is that the question? So the question is how to stop losing money? All right. Let me rephrase that question. How do I stop blowing my accounts? Right? That's a good question, right? Because as we know, most traders, 95% traders lose money, right? You stop blowing your accounts by controlling your risk, right? If you're bleeding, then apply pressure to the area and stop it at once, right? Cut losers quick and let winners run, right? If you have a fixed percentage, and this is the topic in chapter 6, which is uploading right now, right? It's taking a while, but watch chapter 6. And chapter 6 should clarify the answer to that question. Right? It's a very important chapter of risk management. Any other questions, Adam? All right. Those are your questions, folks. Compiled and asked. Now I'll upload chapter 6 and 7. Right. Chapter 7 is shared, by the way, in it's shared from SOT, right? Previous mentorship I had, right? Which is not open right now. Don't ask. Maybe in the future, right? But it's not open right now. Chapter 7 and 6 are uploading as we speak. And that marks the end of the live stream. I hope you found it insightful. I wish you good luck to trading. Study for the exam on the 7th of May, right? It's in a couple of days, I think. Yeah, you have 5 days left. Maybe I'll extend it, although I doubt. Right? The exam's the exam. So you have 5 days left to study the exam. Top 3, of course, will get a $100,000 account each. Study well. And they'll get a private group with me where I monitor their progress and see what happens. All right. Wish you good luck. Good trading. Happy studying. and see you on the 7th of May. All right. Can you